Hey everybody, my name is Dylan Bray, and today my topic is Statement of Cash Flows from the Learning Module Understanding Financial Statements. What is the Statement of Cash Flows? The Statement of Cash Flows reports on a business's cash receipts and cash payments for a specific period. It also reports why the cash balance on the balance sheet increased or decreased. The Statement of Cash Flows reports where cash came from and what it was spent on. The purpose of the Statement of Cash Flows. The Statement of Cash Flows is used to predict future cash flows by looking at past receipts and payments. It also helps to evaluate managers' decisions. If they make a good decision, it helps the business. However, if they make a bad one, it typically hurts the business. It also helps to predict the company's ability to pay debts and dividends, which are the two main things investors and creditors are interested in. What are the three sections of cash flows? The three sections of cash flows are operating activities, investing activities, and financing activities. The operating activities are activities that create revenue and/or expenses in the business. It reflects the day-to-day operations of a business, such as cash receipts from customers and the cash outflows for purchases or payment of operating expenses. The investing activities are activities that increase or decrease long-term assets. Some long-term assets include property, plant, equipment, notes receivable, and investments. This section of the Statement of Cash Flows includes the cash inflow from selling and the cash outflow for the purchase of these long-term assets. It also includes the loaning and collecting of long-term assets. The financing activities are activities that increase or decrease long-term liabilities and equity. Some long-term liabilities are notes payable, bonds payable, and mortgages payable. This section of the Statement of Cash Flows includes issuing stock, paying dividends, buying and selling treasury stock, and borrowing money. How to use the indirect method. The steps that are taken in order to use the Statement of Cash Flows by the indirect method are: Step 1. You need to complete the cash flows from operating activities using the net income and adjust for increases and decreases in current assets and current liabilities. Step 2 is to complete the cash flows from investing activities by reviewing the long-term assets on the balance sheet. Step 3 is to complete the cash flows from financing activities by reviewing the long-term liabilities and equity section of the balance sheet. Step 4 is to compute the net increase or decrease in cash during the year. The change in cash must match the change in cash reported on the comparative balance sheet. Step 5 is to prepare a separate schedule reporting any non-cash investing and financing activities. Applying the Statement of Cash Flows. For the entry-level professional, they will not have any knowledge about the Statement of Cash Flows or how to apply it because they are simply doing what the mid-level professionals tell them to do. The mid-level professionals will have some knowledge about the Statement of Cash Flows and how to apply it. These professionals will be around the operating activities all the time and a little of the investing activities as well. The executive level professionals will have full knowledge of the statement of cash flows and will know exactly how to apply it in order for the business to grow and continue to succeed. Thank you for your time, and I hope that by viewing this presentation you have learned a little bit more about the statement of cash flows and how to apply it. Thank you.